to the. All right, so we're ready to get going. Thank you guys for attending our manufacturing industry webinar series. This is a part 2 that Nick and Chris have both presented on for a part 1, and they are going to talk about how to maximize the value of a company. And throughout this presentation, if you have any questions, you can just put them in the chat, and we'll take some brief pauses throughout the presentation to ask some questions, and then also, of course, have some questions at the end. So Nick and Chris, I will pass this on to you guys.
Thanks, Katie.
Thank you.
And welcome everybody, and thanks for joining. My name is Nick Dunnom. I'm a business advisor with Sunbelt Business Advisors and True North M&A. More on the kind of delineation between those two here in just a second. And I'm here today with Chris Jones, the CEO of our company. And I want to thank you guys for coming to learn how to maximize the value of your business today. So a little bit of an overview on just who we are, and maybe a little bit about how we do things as well, just to maybe provide some depth and weight as to why you can regard the information that we have to share with you as both valuable and accurate. So if you kind of think of this as a two-pronged approach, we're one company with two solutions. Our Sunbelt Business Advisors product, if you will, is where we work with companies that do up to $10 million in annual revenue, affectionately referred to as Main Street business. That's 80% of the companies that are out there. Right? Now our True North product in M&A, or mergers and acquisition, that's where we focus on companies that do $10 to $150 million in annual revenue. And altogether, that's about 99% of the businesses that are out there. It's really only that the really, really big business up here at the top that we don't work with. We usually work with founders, family-owned businesses that are going to transition it to the next generation, maybe sell to an internal buyer, or make their exit, right? And I won't get into too much detail with the information at the bottom, but just again, as a little bit of a validation, we sell more business than any other firm in the entire country, period. And I won't bore you with the rest of it. So, why is this important, right? A good question to ask if we're going to spend the next 60 minutes here talking about this together, right? Every owner is going to exit their business someday, right? Whether it is with a plan or without. And what I've learned after speaking to and meeting with hundreds of owners, right, is they oftentimes wait until they're 3 yards short of the goal line to prepare for this. And they oftentimes will use, there are tools out there that you can use to try and do this. But I've found that those inputs are often flawed on the quantitative side of things, which is what we talked about in part 1, last presentation, kind of the hard data, the numbers of your business, right? They just plug those numbers into some software program and it spits out a value. But those programs oftentimes disregard the qualitative side of your company altogether, right? And that's what we're going to be doing a deep dive in today, and talking about how to maximize the value of your business, and inherently hand in hand with that, make it more efficient, help it grow, and become a better company in the process as well. So now to recap in part 1 on how to value a manufacturing or fabrication company, there's a ton of different methods out there that you could use to value a company. But the 3 most common that you will come across, you've got the cost method, right? What is this stuff worth, your tangible assets? You've got the market method, which uses industry rules of thumb, okay? And you have the income method, which is kind of the final major method of valuing company, which is some multiple of current earnings or projected future earnings. And because the vast majority of actual business buyers use this method, that's what we focus on. And that's what we'll focus on today. So for examples and communication purposes, let's just assume we'll be using an income method of valuation. One caveat to that, right, is that this method is appropriate for a mature and profitable company, okay? It is not appropriate for a company that is in distress or an emerging or a startup business, right? So for today's conversation purposes, we'll assume a business that's been around for a number of years, they're profitable, and they're ready to either transition it or make their exit. Okay. Is there any question on the methods of valuation at all? I don't hear anything, so we're going to move right along. And you might hear me, it might sound a little bit redundant, right? And hitting home the income method evaluation, that's intentional. And when we're using the income method evaluation, there's a lot of stuff that goes into that as well. You've got tangible assets like equipment and inventory. Sometimes real estate is owned and involved or part of the transaction. And you've also got a lot of intangible assets within your business. And we're going to be doing a deeper dive into some of those today in the value drivers or key characteristics of your business. You've got customers, you have employees, you have suppliers, and those relationships inherent with those people, right? You might have contracts in place with your suppliers or customers, different capabilities, your technology, your software, your programs, your documentations, etc. All of that stuff, the tangible and intangible assets within your company that is going to generate the income or the profit that we'll use as the basis for that valuation is included in that valuation. But what is, oh, I jumped over a slide there. And when we're talking about these tangible and intangible assets, and kind of foreshadowing what we'll be talking in depth here a little bit later on in this presentation, these are the key metrics that buyers are going to use when they're evaluating a company for acquisition. Okay, outside of just the earnings, they're going to be looking at barriers to entry, industry strength and trends, your company's history, not just your customers or your customers' loyalty, but the concentration or diversification of that customer base. How is that revenue coming in, management and employees, and all of these other characteristics within your company. But to continue on with the income method evaluation, the real question to ask is, what is the value to the buyer, right? Because beauty is in the eye of the beholder in this situation, right? And that beholder is the buyer. Well, most buyers are interested in the immediate revenue trends, the earnings of the company. And then depending on what type of buyer you're working with, if it's a strategic buyer, you're likely going to solve a problem for them, or you're going to unlock a capability that they're seeking. If you're working with a financial buyer, again, they're focused on the financial performance of the company, and they're going to find value in all of these different assets and then some as well, right? And when we're using the income method evaluation, there's two measurements of that income that we're going to focus on. The first of which is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And the second is seller's discretionary earnings, or SDE. Okay. Now, EBITDA is more appropriate for companies on the M&A side of things. Perhaps they're absentee owner, there's the opportunity to do so. Perhaps it's a strategic acquisition opportunity. SDE, more appropriate for the Main Street side of things. Okay. Again, if we think True North M&A on the M&A side of things, and Sunbelt Business Advisors on Main Street side of things, SDE more appropriate on the Sunbelt Main Street side of things. They're owner-operated businesses, okay? And that's the key difference between the two, is you get to add back one of the owner's compensation to the bottom line. Now, the reason why you get to do this is because it's likely that the buyer, whoever that buyer is going to step into the owner's role and assume that salary, okay? And one key thing to understand here is what we're doing is recasting or normalizing expenses, right? As owners, it's likely we went through this with our accountants or our controllers in the beginning of this year, right? During tax season, we as owners get to use every legal opportunity that there is to reduce our taxable income, right? And our accountants are very good at this. And so the issue with going to sell a company is, you whip out the last 3 to 5 years of corporate tax return, and again, shifting our perspective to the eyes of the beholder or the buyer in this situation, their eyes go immediately to the bottom line without cleaning up or normalizing these financials, right? And so whatever those one-time, non-recurring, not normal expenses are that are in the business, those need to be recasted and added back to the bottom line to show the true earning power of the business.
And if I could just underline some of that Nick's saying there. By the way, I apologize for the acoustics. I'm conferencing in for the Minneapolis airport right now before I hop on a flight, so I hope the sound's not too bad. The a lot of business owners with successful companies are approached by strategic buyers or private equity groups or just buyers who are in general interested. And one of the business's biggest mistakes you can make as a business owner is to just hand your financial, yeah, you can get a non-disclosure agreement, but to just hand your financials to a buyer and not have them normalized or recast like this slide talks about. One, you're not showing the true earning power of the business. Two, you've limited the story of your company to what a P&L and a balance sheet says, which is far from the whole story of most companies, right? You've got a growth story, you've got a people story, a customer story, a capability story. But specifically on the quantitative side of things, even if you end up talking to a buyer by yourself, which we don't recommend, don't start out by just handing them your financials, and don't hand them your financials until they've been normalized or recast. Otherwise, you're going to be selling yourself short.
Yeah, exactly. Thanks, Chris. And so when we're looking at recasting, here's an example of that. This one won't get too far into the weeds, especially on the recap of part one, but I just want to illustrate how that works. So if we're looking at the front page of a corporate tax return or maybe a P&L statement, we're going to go to the bottom line and see that there's a NOI or a net operating income of $800,000 on this business, right? Now what we get to do is we get to add back the interest, taxes, depreciation, and amortization. Okay, in this business, it looks like we're servicing some debt. There's $100,000 worth of interest. We get to add that back. $100,000 worth of depreciation, right? We get to add that back to the bottom line. And so the EBITDA of this business is $1 million. Okay. Now, to simplify the process, what we'll do is we'll do some research. Okay, we'll look at industry, size of company to determine what is the average or median multiple that a business like this is going to earn or fetch in the marketplace. We'll apply that multiple to the EBITDA. And again, this is way oversimplified, but in this example, we've determined that this business is worth $4 million. Okay. Any questions, any comments in regards to recasting EBITDA? Okay, moving on. So I've got a big warning for you all here. Okay, what we just did in our recap is talk about how to figure out kind of the average or median value of a company, right? We looked at and recast the financials to determine the EBITDA or the SDE, whichever is appropriate for your business. Okay, we find the multiple, we apply that multiple, and come up with a price. Okay, but we can't stop there because medians and averages, that's just the middle. Okay, and a great way to illustrate that is with this images. This is the flaw of averages, right? The average depth of this pond, 3 feet deep. This guy trusted and relied upon that sign, but he's having a bad time. He's in up over his head. Okay, the same applies to business and company values. Okay. Now, these multiples that I'm going to show you, again, are medians. They're our starting point. They help us determine where we're going to start at before we start doing our value driver assessment. Okay. And if you look here in the top row of manufacturing, you'll see the transaction multiples by EBITDA size in this industry, right? And what you'll see is that as the amount of EBITDA grows within a company, so does the multiple. Okay, the multiple tends to follow that EBITDA size. In up to $1 million in EBITDA, you'll see that it's a 4.3 multiple. That 1 to 5 range is 5.5 and 5.5 again for 5 to 10 million. And then it jumps to 7 and 7 and 7.5. What that's referred to is a size premium. Okay. And it's not necessarily due to the sole fact that the company and the cash flow is larger. It's oftentimes hand in hand with that. But what these companies get to deploy are measures to make the companies less risky, right? They have a sales team and department heads, and they're less owner-centric, making these companies not only larger in size, but also less risky. And so because of that, they're going to earn a size premium. Okay. And so again, what we just recapped, okay, is the quantitative side of valuing companies. It's just one side of a two-sided coin. Okay, we've got our starting point. Okay, but we can't stop there. And a great way to think about this is the value of a diamond, right? If I were to ask those of you attending, you know, what is a 10 karat diamond worth? Okay, we're going to get a range of answers. And if you actually look up online, a 10 karat diamond's value is going to range anywhere from about $150,000 up to $1.2 million. And so the average or median value might be $600,000, but that's a far cry away from where it actually could be, right? And so we can't stop there. We have to look into what are referred to as the value drivers of your company, the key characteristics that are either going to move that needle down in value or hopefully after today, up in value. Okay. And before we get to that, I want to take a look at today's market, today's business market in the country. Okay. And I've pulled this data from government pages. And basically what I want to illustrate with this, not only how many businesses are in the US, okay, but the trend that's coming, right? Bloomberg Financial came up with an article a few years ago, the Great Acquisition, or where they kind of coined the term silver tsunami, right? And basically in that, they said that by 2037, 100% of baby boomer business owners, say that 5 times fast, right, are going to reach retirement age and will be looking to exit or transition their businesses, okay? Now, if we just do some simple math, right, there's 33 million or so small businesses in the US. Now that takes into account a lot of smaller LLCs, maybe sole proprietors, but if we account for businesses in the US that have at least one employee, baby boomers own about 66% of those businesses, okay, totaling about 13.5 million, okay? And so transitions are estimated to be in the millions here, just starting in the next year or two, okay, as baby boomers begin to enter the market in mass and look to transition out of their businesses, okay? And I hope everybody perhaps had some time to get away and celebrate fishing opener. I know up here in Ely, Minnesota, it's almost like a religion, right? Businesses are closed, everybody gets to go out and go fishing. And so oftentimes when I'm meeting with and speaking with owners, this is the perception, right? At first conversation, it's, you know, Nick, I have this big, beautiful business. This company's been great to me and my family has provided a livable income. Somebody would be lucky to have my business. And in fact, it's my and Chris's job to convince people of that, right? But the reality is that there are also a lot of other really nice companies out there, right? And as the trend continues to shift and baby boomers begin to exit their businesses en masse, right? There's going to be more and more available opportunities on the market, okay? And so that's why we need to do things now in preparation of that to make our businesses not only more efficient and better and grow, right? To be able to stand out from the other opportunities out there, right? And have some clearly visible differentiating values that make us stand out from the crowd. Okay? And that's what we're going to get to when we talk about these value drivers. And Chris, if you want to hop in and take it from here.
Thank you. By the way, I looked up 10 karat diamond prices while you were talking, Nick. You can get a lab grown for 14,000.
Wow.
So, but talking about quality, right? And qualitative factors. Then ranges, I saw some ranges, obviously hundreds and hundreds of thousands of dollars higher than that, based on, I just think it's such a good metaphor for it, the color, the clarity, the cut. And that's what we're going to talk about next, as we talk about value drivers. But to give Kevin an overview to everybody, at the end of the day, business prices or multiples of EBITDA are driven by risk and growth. If you just want to put big categories together of what's going to lift your price or depress your price, it's risk and growth. Buyers obviously don't like risk. None of us do. They don't like uncertainty. We're working on a few transactions right now where the tariffs emerged as an issue while we were in due diligence. One of those deals because the tariffed products are such a big part of their inputs, that deal's been put on pause. Another, we're working through it and are coming up with solutions. But as you might imagine, the buyer sees risk or uncertainty there. So they either want to pay less or have friendlier terms. Other things that can drag down price that are considered risk, just a short list, are inconsistent revenue or earnings, like you might see in a construction business with 5-year cycles, or it's very sensitive to the economy or interest rates. Nick touched on owner dependence, owner centricity, low barriers to entry. Uh, if you looked at the multiples besides manufacturing, you would have seen that retailers tend to have lower multiples, as do many hospitality businesses like restaurants, because they're considered lower barrier to entry. Low asset businesses or few assets, a mature declining industry, of course, big dependence on one customer or overall big customer concentrations, or low repeat customer factors, right? Maybe you don't have any annual or recurring revenue. Those things will all drag down price. Um, the correlation between value and risk is really multifaceted, just like that diamond. There can be risk with customers, the industry and end markets you serve, tariffs, of course, supplier, supply chain. Do you have redundancy? What about competition? Are you on a short list of folks or businesses that know how to do what you do? Are you the tier one provider in that space? If so, you may be able to, if you're the number one player in your market or your product, you may be able to demand more for your business. You'd certainly be more attractive to buyers. And then management and financial quality. Having especially having a senior leadership team that shows the business is not dependent on the founder or owner is huge. Having quality financials that makes it easy for a buyer to understand the moving parts of your business and to do quality financial analysis is also huge. All that comes together in their overall thoughts on investment risk. We'll give you a few practical examples in the next slide. Um, here's an example of customer concentration. Now, for the purposes here, we've selected 4, 5, and 6 time multiples. And if you look in the middle, we're saying, hey, this company has in their top 10 customers a concentration that those top 10 account for less than 50% of their revenue. Let's assume every one of those is 10% for easy math. You could lose a 10% customer and it's going to hurt, but it would be moderate risk. It's probably not going to put you out of business. That customer can be replaced. If we go to the left of that, we see that someone has their top 3 customers accounting for 90% of that revenue. Let's say each one of those is 30%. 30% obviously is going to be harder to recover from. So in this very simple example, using just that value driver, that company, let's say it's a manufacturer, might fetch only a 4 time multiple. They could both have $1 million in earning power or EBITDA, but the one on the far left might get $4 million. The one in the middle might get $5 million. Now, if we go over to the right, with a business that is highly diversified, no one customer is less than 5% of the revenue. That's lower risk. It's higher growth opportunities because that each of those 5% customers could result in more business. They could be grown or they could be added to. There's obviously an engine that's doing that, and therefore a higher multiple. So low risk, high growth equals higher multiple. In this case, that could be a 6 time multiple or $6 million for a business generating 6 million in EBITDA. So look at that swing. Just using this very simple example, you could be talking about 4, 5, or $6 million or a $2 million spread for a high quality, lower risk, higher growth opportunity company versus one that does not have those same attributes. It's not that any one of these makes the company unsellable. It's just buyers are going to discount for risk. They'll pay a premium for growth. So one of the most powerful things you can do as a business owner is learn how to think like a buyer, as Nick alluded to earlier. If a third party looked at my business, where would they see risk? Or what keeps you up at night, right? Of what could hurt the business or the struggles you have. And even if you're never going to sell the business, you're going to live forever. You're never going to want to sell the business. You think you're going to enjoy it forever. Um, or even if you're going to transfer it to an internal buyer, like an employee or a family member or a partner, I would still encourage you to attack these issues because it'll make your business so much stronger and so much more enjoyable to run. As a business owner myself, who's tackled some of these issues, not all, but has tackled some of them. I can tell you, it makes the business better for everybody, and certainly the owner. Could I grab the next slide, please? Let's skip over one more. These are just more examples on the customer side, but I want to show you guys some other examples. Industry and end markets. So if you have a business partner or a spouse that's involved in the business, or family, or a trusted advisor, if you want to have some fun slash maybe stir up some controversy, but it would give you some uh, interesting feedback on your company, take each of these slides and have another party besides yourself who knows the business well score it. So they could go in here and say, our industry and end markets, are our products completely discretionary? You know, when the economy gets tough, do folks have to buy our products? Or is it like, say, entertainment purchases that might get cut back? Um, People should or need to have your solution, would put you in the middle. But what if it's something like groceries or energy, right? Food or energy, it's a must have, it's non-discretionary, right? That would be considered a high or positive value driver. And you can see each of these lines give you those examples. Nick also shared a worksheet earlier where you saw scores across the top, -2, -1, 0, 1, 2. That one's probably a little bit easier to use in these slides, and you give yourself an overall score. But again, what this does is reveals risk in your business. And every business has risk, of course, especially small businesses. It also reveals where you have strengths and what might make you very attractive to a buyer. And that gets to telling the story beyond your financials, right? Here's why our earnings are likely to sustain. Here's how we might be better than our competitors or our peers. Here's why we're likely to continue to grow. And buyers are ultimately buying the future. And so the more of these average, or better yet, high value drivers you have, or positive value drivers you have, the better, because it points to sustainability, health, um, and just the resilience of a company as well. Could I get the next slide, please? We were talking about tariffs earlier. Great example of why this is such an important one. Suppliers. This could also be your contractual relationships that you have. If you have concentrations in your suppliers with no redundancy, that could be an issue. On the other side of that, if you've managed to get a multi-year supply agreement with exclusivity, if you see the second one down on the right, that could be a huge positive. During COVID, we sold a sizable distributor of surfaces and cabinetry, and while a lot of that industry had gone to overseas fabrication and production, kind of mass-produced stuff, this this company had stayed largely domestic. They had overseas relationships, but they also had domestic relationships. So while a lot of their competitors could not get inventory while COVID is going on because the ports were all backed up and COVID created a lot of chaos, they were able to capitalize on that. And many of those relationships were exclusive. So they were one of the few people in the Midwest with enough inventory to do big multifamily projects that they were doing, big condo projects. And they did fantastic in that. And that was something that was really attractive to the buyer when they wrote their offer. So exclusivity, being able to lock other competitors out, or annual contracts, or having some, maybe being one of the larger folks in your space, so you have some negotiating power, also can be very beneficial in the supplier side of things, and giving yourself a report card. Can you get the next slide, please? Competition. We touched on this a little bit already, but as you might imagine, there's nothing wrong with being in commodity products or services with low margins. That's a type of business model. But if you have either, if you look on the top line, limited alternatives to your products, or you're able to differentiate them in some way, or if you're able to add something proprietary to your product, you're going to be able to drive higher margins. And if the proprietary nature of that, or again, if there's any exclusivity, or you're one of the few market leaders, then that can be huge, especially if you can show that can scale outside of, say, local to regional or even national. Then you're talking about some really knock it out of the ballpark kind of multiples, especially the larger you get. Another thing I'll point out here in competition, this kind of gets to barriers to entry, is if you look at that middle column, last bullet point, would it take new entrants a significant investment to compete? So we're talking to manufacturers right now, and the answer is yes. If you're machining or fabricating or whatever type of investments you're making in fixed assets, kind of CapEx investments you're making, they're going to be significant in this industry. So that answer is yes. That's true for most of your competitors too. But if you've gone above and beyond, whether it's in automation or robotics, and you have capabilities your competitors don't have, you have skilled personnel that your folks don't have, that is also going to set you apart because obviously you'll have less competition there. Nick, could you grab the next slide for me, please? Management and financials, I've kind of already touched on. Um, what what I would just encourage you to do, and again, this falls within, even if you're, never going to sell. I mean, we're all going to have to exit our business someday, right? Whether it's to an internal or external candidate, but this is one of those areas, lean into your accountants for recommendations. Um, Go beyond. A lot of business owners don't rely heavily on their financials on a monthly basis, is what we found. It's more for tax planning, maybe quarterly. But if that's you, get in the habit of looking at your financials as if you've never seen them before, right? And start asking yourself some questions about how clean are they? How understandable are they? And if you're already doing that, kudos, that's great. But we even see, companies have gotten the 10 million revenue level and beyond that maybe don't pay as much attention or don't scrub those numbers as much as they should before they go to market. And that can be an easy one to work with your accountant and with us on, just to make sure you're market ready. Next slide, please. So I just want to give you this is one of my favorite slides. Our process is called the quiet auction, and this is a case study of us executing the quiet auction for a client. In this case, the client was targeting 80 to 100 billion, so one of our larger projects. And we went to market without a price, which we often do if you're dealing with a company that's at 2 million or more in EBITDA. Sometimes even if it's only a million in EBITDA. And we can even use the quiet auction process, frankly, for multiple offers on smaller businesses. But in this case, we went to market without a price. And our first offers are in blue here. And you'll see, look at the wide range of offers. The lowest offer, excuse me, was 63 million. The highest initial offer was 115 million. Now, why so different? When we run these quiet auctions, we basically we give these buyers a date, and they sign a non-disclosure. We give them a 30-page document that tells the story of the business called a SIM, or confidential information memorandum. We answer initial questions, and we ask for an indication of interest, or first offer. They all saw the same information. They all were probably fairly knowledgeable about the industry. They're at holdings in it already. You'll see some of these folks are private equity groups, publics, companies, the financial buyers. These are sophisticated parties. One thinks it's worth 63 million, and the other thinks it's worth 115 million. And if you heard what Nick said earlier, beauty is in the eye of the beholder. It is so true in business sales because you're selling something that's super unique. And this business ended up being purchased by the public strategic you see in the middle, because of its great strategic fit. For them, it had the most value because it helped them complete some capabilities they wanted for vertical integration. So it was worth a lot more to them than a public strategic who happened to be their competitor, our seller's competitor on the far left, who only offered 63 million. And typically that's what you're going to find. A strategic buyer will pay a lot more than one of your direct competitors who's right in your backyard. Your direct competitor, who can manufacture what you manufacture, um, already has a brand, they already have people, they already have all the value drivers to some extent. So what are they really getting? Well, they're eliminating you as a competitor, and they're maybe getting a customer list that is accretive to what they do, but there also might be overlap with that customer list, right? Maybe you share 50% of customers, so now they only value half the customer list. Whereas a vertical integrator, everything you have is valuable to them. It's all accretive, right? Everything they're acquiring from you adds to their capability. Every customer, every capability you have, every presence in the market, more than likely. So not only did they put out a strong initial offer, our client really liked them. We asked for their final offer. They added another 15 million. And then we said to our client, well, excuse me, we said to the buyer, our client really likes you. You're not the top offer. Can you do any better? And you'll see in green, they added a premium of 15 million as well. And this ended up being a $120 million transaction. Now, keep in mind, our client was targeting 80 to 100 million, right? So we were, by not going to market with a price and running a quiet auction process, we were able to talk to a bunch of buyers at once and see who saw the most value at that auction. And we don't use the word auction with buyers, obviously, but we were able to talk to a bunch of buyers all at once and see what their perceived value was. The other thing that's super valuable about this, and why I would encourage you whenever you exit your business, um, don't put yourself in a situation where you only have one buyer to talk to, because you don't know which one this is, right? Did you get the $63 million buyer or the $120 million buyer? Now, by the way, if you're looking at the far right and saying, well, wait, there's one for 140 million, this gets back to quality. That was the highest quantity of offer, but we were not convinced that that buyer was the best fit or had the best chance of getting to the closing table. So um, our client, including based on our recommendation, said they want to go with 120 million, which already exceeded their goal anyway. And we were confident that would get to closing versus maybe taking a higher price that would never get to closing. So I spent a lot of time on that because it's my favorite slide. I think it really illustrates a good process to go through, especially if you have a more sizable business. But even if you have a smaller business, that quiet auction approach can work. Certainly talking to multiple buyers can work. And if your deal falls through, you know what the rest of the market said, right? In this case, we could have, if our $120 million deal, let's say they had a big issue during due diligence or something happened with their capital, we could have pivoted. We knew we had in our back pocket a $115 million offer, right? And we could have moved to that on that blue bar you see on the right. We knew what the market had said. So, Nick, can you give me the next slide, please? Um, this is another example, and this is kind of cool because this is an example of why you should get an idea of what your business is worth today. I um, just like my wife is always pushing me to go in for my annual physicals so I can get, what do my blood tests say? What does all that stuff say? Is it going up or down? Um, and then setting goals off that, you can do the same thing here. So in this case, we gave an initial valuation to the client and we just did a gap analysis. Like, what do you need it to be? What do you need that price to be to unlock the next chapter of your life? And they needed it to be significantly higher. And this was, I think this is the one that sold for 27 million, right, Nick? If I recall correctly.
Yeah,
Thank you.
that's correct. Yeah, 27.2.
So you can see when we first talked to them, gosh, 2017,
Mm-hmm.
around 5 million in value. We told them all the things they should do to drive the value north. They listened and did those things, and then ended up exiting at a value of 27 million. So obviously a lot of work happened during those 7 years, but they were able to get pretty extraordinary results with both their earnings going up and their value drivers going up.
Mm-hmm.
I grab the next slide, please. Just one other comment that I want to make here about things that affect price. If you imagine that your business is the one in the middle, that dot in the middle, that's you. Who's closest to you? Your employees and your competitors. And you can put your partners in there too. Although those folks might be great buyers and interested in the business, they may or may not be from a interested standpoint. If one of your goals is to maximize the economics of a sale, the chances of them being the buyer who pays the most is slim to none. And I don't mean this in that they don't respect the business, but generally, for example, employees, familiarity can breed contempt. We've literally been part of consulting projects where an employee expects the business to be given to them, or a family member expects the business to be given to them, not realizing it's worth $2 million, right? They're so close to it. They've been in it for so long, there could either be a sense of entitlement or they're just not sophisticated enough to understand how businesses are valued. Whatever the factor is, that can happen. So we sometimes have clients that say, hey, look, I want to give it to the family and I'm okay with sacrificing price. And that's okay. We see that all the time. But it's still super valuable to know what the fair market value of the business is. So they at least know what the gift is. And there may even be some tax advantages to knowing that. Um, as you get further away or outside the company, you'll generally find that buyers see more value. High net worth individuals be the next ring out, small investment groups, private equity groups, and like I touched on, strategic buyers. But the basic premise is this: the further away you get from the business, geographically, customer mix, industry served, capabilities, the more that you have something the buyer doesn't that they want, likely that they'll pay more, right? Like getting them into a market, somebody's East Coast, West Coast, Gulf Coast, maybe does something similar to what you want to do, but they want to enter the Midwest, and you can get them into that market overnight. They don't have any presence there now. That could be a lot more attractive than them trying to do it organically and take all that risk of competing with you in that market. So hopefully that makes sense. One example I'll give you of a strategic buyer before Nick gives me the hook here and I jump on an airplane. The This is an article about DRC, Design Ready Controls, which is based in the Twin Cities. This is a company that's well north of 100 million in revenue. I don't even know where they're at right now. They're significantly north of that. They acquired Fabrico. So it's a manufacturer acquiring a manufacturer, smaller manufacturer. And if you decide you want to read this article, what you'll find is it was all strategic. And I can tell you, because we were the intermediary in this transaction, I can tell you that DRC paid more than a lot of buyers would for this business because of the strategic fit, right? And a lot of other value drivers. But they were an ideal buyer for this business because they wanted to bring fabrication in-house. They're a control panel manufacturer, and they'd been outsourcing their control panel boxes to a fabricator. And for a whole bunch of reasons, they control, scaling, price, et cetera, they wanted to bring that in-house. And they looked at a lot of companies, and Fabrico eventually was the one that was the best fit. And Fabrico did well, and DRC was also happy because of that fit. It created a lot of value. So, all right, Nick, I'll shut up.
Thanks, Chris.
Yep. Thank you.
Yeah, and then this will be short and sweet as we kind of land the plane here while Chris takes off on his. But to really bring it into focus, right? I know we talked about a lot today. Recap on part one, how to get there, how to assess your value drivers and do a self-assessment, maybe a fun exercise to have some third parties do an assessment with you, right? Provoke some good conversation. Okay. To tie it all together, right? What buyers are looking for gives you a good idea of the metrics within your business, right? First and foremost, they want to see strong financial performance, right? They want to see consistent revenue growth, healthy profit margins, and a solid financial history, right? Secondly, and don't take these in any order of specific importance, right? But secondly, they want to see growth potential, right? What are the opportunities to expand the business further, right? Having that clearly outlined prior to speaking with suitors is going to be a key indicator of your success or not. Outline your growth strategies and demonstrate how you are poised for future success. Skilled and committed workforce. one thing I guess we didn't really talk a whole lot about these value drivers in today's presentation, right? But and I don't think it's a secret to any companies out there, right? The labor market today is extremely valuable, right? And so buyers are going to be keenly interested in seeing skilled, motivated, and a committed workforce, right? Retention rates and even a well-documented org chart, right, can be good indicators of a strong team. A strong customer base, right? Again, being very interested in the fact that you have strong relationships with your customers. And what is the customer concentration risk, right? Do you have 2, 3, 4, 5 key customers that account for a large percentage of your revenue? Or have you been able to diversify that a little bit, right? To the point where, a good metric is 10%, right? For each customer. Even better yet, 5% or lower. What are the barriers to entry? Well, in manufacturing and fabrication, they're pretty significant, right? There's a lot of capital and regulatory barriers in place. Do you have, like we were talking about earlier, some intangible value, right? Do you have intellectual property, patents, trademarks, copyrights, proprietary technologies, software, programs, okay? Make sure that that's all well documented and protected, okay? And as well as your physical assets as well, right? Buyers are going to be considering the quality, the maintenance, the condition of your physical assets as well, whether that's real estate, equipment, or inventory, right? And then a reasonable valuation, right? If we do get to the point where you are seeking an exit, whether that's internal or external, right, making sure that all of these assessments line up and support a reasonable valuation, right? If you're going to market with a price, okay? If you're going to market without a price, right, that's going to be more of an internal decision, right? Coming to a reasonable valuation as a benchmark of what you're willing to go for. Right? One of my favorite old sayings, right? Best time to plant a tree was 20 years ago. Next best time is today, right? And so if you're a company that is either looking to exit or looking to become more efficient or grow, right? Sometimes it can be daunting, right? If you're looking short term, or even if you have a few decades of runway left in front of you, right? But starting today to work forward towards your goal is the best recipe for success. And to reiterate that, preparation is key, right? Buyers are going to conduct what's referred to as a look back, and they're going to do 3 to 5 years at a minimum when evaluating a company for acquisition. And so for your own personal goals as a company, whether it's growth focused or exit focused, right? Determine your goal and then figure out where you are currently with those 2 key metrics, just like Google Maps, right? That's the easiest example I could give, right? As long as Google Maps has 2 key metrics, where are you and where do you want to be? It's easy for them to map out a clear and most efficient path to get from that, where you are to where you want to be. Okay? Look at the past as an indicator of the future. Your buyers are going to do so. And some good questions to get you thinking about some of these things, right? And how to present your company in the best light, right? Is what is the total addressable market for your business, right? How many customers are out there that you can get, right? How are you going to grow your business? Again, what are the clear paths to growth that you can see or that a buyer wants to be able to see? And why you? How do you become that purple lure, so to speak? What are your clearly visible differentiating values? What separates you from your competitors? What makes you unique? What makes you attractive? What makes you desirable? And then another great question, money aside, right? Get that thought out of the way. But money aside, what investments are you going to make next into your business? What's the next hire? What's the next technology that you're going to implement? The equipment you're going to purchase? Is it automation? Is it robotics? Right? What investments are you going to make your business better? Okay. And finally, to recap, part 1 stuff, define what's being sold, your intangible and your tangible assets within your company. Measure your EBITDA or SDE, whichever is more appropriate for your business. Define your starting point. Okay. Research, find some multiples for your industry and the size of your company. Apply that multiple to your EBITDA or SDE, and then do a value driver assessment. Okay, is that needle going to move down or up? Is there a lot of risk inherent in your company? Does your company, and this can be a tough question to ask objectively of your company, right? But is my company below average? Because there's risk inherent within it, right? Do I deserve a discount on the multiple? Or am I growing and I have good trends and good diversification? Do I deserve a premium on that multiple? Okay. And then finally, understand what buyers are looking for. If you do all of these things, you're going to have a much more enjoyable experience. You're going to position yourself and your company in a much better position when you are looking to make your exit, or if you're growth focused, right? Like the impact study that we shared with you earlier on that company's growth journey from a $5 million company to a little over a $27 million company. They grew from $1 million in EBITDA up to $5 million in EBITDA, right? That gives you a lot more breathing room and a lot more gas in the tank and a lot more wood in the woodshed to be able to make some decisions and de-risk that business and make it more efficient, more enjoyable to stick into if you change your mind and it's not time to exit. So with that, I want to thank everybody for watching and for attending. Again, my name is Nick Dunnom with Sunbelt and True North. We got Chris Jones on here with us, CEO. And are there any questions that came in, Katie, that we can address, or should we wrap things up?
Yeah, we can wrap things up. There's nothing in the chat, so it was
Okay.
a great presentation if there's no questions, I think.
Okay. Well, thanks again, everybody, for attending and watching. And thanks, Katie, for having us.
Yes, of course. Thank you guys. Have a good day.
You
Thank
too.
you. You too.